All right. So, we wanted to put out something to talk about, a lot of the questions that we're getting related to portfolio management and how we've been doing in our portfolios and what we've been doing in our portfolios. So I brought Craig White on the call with me here today to talk about this and illustrate the points. So, Craig, one of the questions we're getting lots of is like, has the market bottomed out? Like, have we seen the worst of it, or are we going to be seeing another downside to this market?
Yeah, so I think that's a common question. There's no way that we're ever going to be able to say that the market has bottomed because it's just not possible to predict that type of thing. And people probably do more damage to themselves trying to predict it. So my best guess is that we are probably not out of the woods yet, and that we're going to see another dip before it's all over. But we haven't made any investment decisions based on that. And I think a better question to ask is how offensive and how defensive are you at any given time? And we were quite offensive, a couple weeks ago when markets were quite a bit lower. Now it's more of a mix because there's less panic. I mean, we've just come off a really strong week now, so um, it's more of a mix between offense and defense right now. But that could change, and it could easily go lower from here.
Yeah. So like when you think about like what we were leading into it, then were there any changes that, and being that you're the one who manages our portfolio models on a day-to-day basis, were there any changes that we were looking at going into the crisis that you think is noteworthy?
We didn't, we certainly didn't predict this, and we didn't make any immediate changes to make the portfolio more defensive in January or February than it already was. But I think, we build portfolios in a way that they are meant to handle the stress of these kinds of scenarios. So, we're kind of always prepared for this. I think probably there's two ways to prepare for a crisis like this, and one is designing a portfolio that is more defensive, but probably the more important way is to talk about financial planning, and you guys and your team are probably more important to deal with that type of thing.
Yeah, like I think that these like it's funny we talk about this. It's like people ask, "Did you see it coming?" And the truthful answer is that we always see that there's something coming. We always know there's something around the road. We don't know it's going to be a coronavirus or it's going to be a financial crisis or anything. But I mean, I've been in the industry long enough to see a couple of these, well, more than a couple of these now, and so we always know that they're coming. And so from a planning perspective, I think if we're doing responsible planning, we're always planning for the next downturn that's going to happen so that it doesn't impact our clients' lifestyles. And that doesn't mean that their portfolios are going to stay level or always that they can't go down in value. But, we build that into all of our plans at the same time. So using like things like a cash wedge strategy to protect their income and taking maybe conservative estimates or assumptions when it comes to rates of return over the course of a plan. There's things that we're always building into it. So we never know what's going to happen, but we do know that they will happen.
Yeah, absolutely.
So then, given that we're right in this right now, what would you say is the biggest thing that we're doing in portfolios right now?
Well, like I said, when a few weeks ago when markets were really panicking, I would say we were taking advantage of those opportunities. And it's funny because I heard a quote the other day that when it's the right time to buy, you won't want to. And that's totally true because it's when the market is the most beat up that you're going to get the best opportunities. And that's the point where emotionally it's the most difficult for you to, pull the trigger and put that money potentially at risk.
Yeah.
And so I think we did a really good job. I think we've set ourselves up to, take advantage of those opportunities and also, come through without having to make any tough decisions having to sell things that maybe had lost money. So and we're still looking to do that. It's less of a pressing issue right now because the market's pulled back 20+% from the lows. So but like I said, we could get that opportunity again very soon. Who knows?
Yeah, like I think we're always looking at rebalancing, and when we look at rebalancing in the portfolio on on the downside and on the upside, frankly, it's always a difficult thing to do. I mean, you think it works equally as bad on the other side. Like like when markets have been roaring over the last 10 years, we've been rebalancing off of like stock positions that have done extremely well to buy into like bond positions or other assets that haven't seen the same growth opportunity. And so that's hard to do. But now it's equally as difficult where you're looking at our protective assets and rebalancing into stock positions that are off 20-30%. And it's a hard thing to do. It's always a hard thing to do. But at the same time, like that's how we maintain our discipline. And actually, one of the things that I think we've done a really good job of talking to clients about this. But whenever there's a situation where somebody like feels like they might want to go to cash and gets completely out of it, one, we know that that's not the thing to do. We know that if you miss even just a few days, the few of the best days in the market, that it could kill your returns for a decade or longer. So we know that you don't want to do that, but I think part of rebalancing is just making sure that people can maintain their sanity almost, but maintain their investment position in the market as well, so that it's comfortable for them. So, we're definitely doing that right now with clients and making sure that, we're not overexposed or underexposed to areas that we want to be in.
Yeah, for sure. I mean, all you need to do is look at what's going on today, because if you weren't invested in the market's probably up, I don't know, 10-15% this week. And that's a 4-day week too. It's a Good Friday tomorrow. So if you weren't invested this week, you might have blown your whole year's worth of returns, if not more.
Yeah, and I think it's almost like one of those self-fulfilling prophecies when you sell out, because it's like either the market goes down and you kind of justify your position and you still feel like like you still don't know when to get back in, or the market goes up from there and you're almost like, well, now I don't want to go back in because I've missed out on this opportunity. It's almost like a double negative outcome when people go to cash in terms of like their behavior towards it. So I mean, I get it. We get it. We work with clients every day, and we understand that there's a behavioral side and the human nature side to it. But I think that's just it. Being disciplined to the portfolio approach or the portfolio strategy is so important right now, and it's the hardest time to do it, but it's the most important time to do it at the same time.
Yeah, I think I like to frame it in those terms of offense versus defense, and it's not a switch that you turn on, black and white like that. It's a spectrum of playing offense or playing defense, and I didn't come up with that. Howard Marks is actually talks about that in his books. And for those of you who don't know who Howard Marks is, you should go check out his books, because he's a billionaire, self-made billionaire who just invests money for a living. So very smart guy, probably a lot smarter than the guys or girls you see on BNN. And he talks about offense versus defense and not trying to time the market.
Yeah. So where do you think the opportunities are right now? I mean, we know there's some opportunities out there. Where are they?
Yeah, so I mean, there are still loads of opportunities out there. I think you can see it in energy or financials or maybe even some industrial stocks. Those are definitely beaten up, and there is some real concerns there, obviously, with the virus. But I think long term, those are going to be very strong returns from where they are at right now. There are really cheap prices on things like airlines and cruise lines and maybe hotels and tourist related industries. We haven't been dipping our toes in too much into those pools, because I think there are real issues for those industries coming out of this. And I just have a hard time seeing what those businesses are going to look like going forward. So our main goal always is not to lose money, and I think even though those stocks look cheap, they might be cheap for a good reason, and so we've mostly stayed away from those.
Yeah, like I think in the aspect of like uncertainty around like when things like tourism are going to come back, because I mean, even after the virus, it might take a little while before people start to feel comfortable with going on a plane and sitting around 150 other people. Even I'm interested to see how even sporting events go for the first little bit. Like, do people come back in droves, or are they a little bit more cautious coming back? And so, like, I think the uncertainty around it is just too difficult to invest in, really. But I think that also like quality is important. And I've been preaching that with a lot of clients. Is that in a lot of cases we're getting almost the same reward opportunity on some what we would deem to be like safer companies as you would on some of the maybe less safe companies, if you will, or more volatile companies. And just because the banks, for example, have gone down so much in value, and so they're down 20-30% off of their highs, and so you can buy a really high quality business and feel pretty good about this business isn't going out of business. We've got bigger problems if they do, but you still you're getting them on a nice discount as compared to where they were before.
Yeah, for sure. And I think, the starting point for any valuation is that you have to have a reasonable prediction as to what their earnings are going to be going forward. And with some high quality companies, you can still do that even with the virus going on. But, like I was saying before, with the stuff like the airlines, it's not possible, I don't think, for people to make a reasonable prediction as to what their earnings are going to look like over the next 10 years. And for that reason, we say it's too hard for us to predict that, so we'll just stay away from it. But, to your point, I think things like, TD Bank or in the energy sector, like Canadian Natural Resources, these are very high quality companies that have very strong balance sheets and very good earnings. And I don't think that their next 10 years are going to look materially different than their last 10 years. So we can still invest in those and have a pretty good confidence that we're going to be close to our prediction.
Yeah. So, I got this question the other day, and I thought it was kind of interesting. Somebody actually in our industry was asking me about, do I think that experience has made us better investors, having been through a couple of these before. So I'm interested in your take on that. What do you think about that? Does experience make us better investors?
I think experience can be a good thing when you learn from your experience. But I also see with a lot of investors that maybe they went through 2008 and they still have the scars from 2008. If the experience is causing them to make emotional decisions around their investments, then I think experience could possibly be a bad thing. Investing and emotions don't mix very well. So if your experience is making you emotional about your investments, then it's probably not a good thing. But in general, I would say, yeah, experience can be good because you've gone through it before, so you can keep a level head.
Yeah, like I think it's like almost like expertise is more important than experience. Not that experience is a bad thing, obviously, but like I've seen investors that have been around for a lot longer than I have, but it's like exactly to your point, like they're almost like gun shy because of what happened in the financial crisis or what happened during the tech wreck and things like that. And so I think that it's actually making them more emotional at this stage in their careers. And I'm grateful. Like I got to be in the industry through the financial crisis, so I'm grateful for that experience. And because I can now go back on that and say like, okay, how did this work out then, and what does this look like today compared to that, and try to take the emotional side out of it as well. And so I think in my case the experience has helped, but I also see that it's not a given that it's a help, because there's a lot of people that I know that we've talked to that are not making, they're making emotional decisions, as you say, and that experience is kind of driving that. So I would just say like expertise and sticking to your expertise is probably the most important thing versus, just the sheer fact of being around for a longer time period.
Yeah, and I think during times like this, you're always going to see people try and draw comparisons from this crisis to past crises because they want to have a reference point. They want to have a relative idea of where they're at. But this is not like 2008. It's not the same cause to the crisis, and it's not going to have the same solutions, and it's not going to have the same, problems. So drawing comparisons is not, in my view, not really that good of an exercise because it's not going to help you very much. I heard on the radio or on the TV that people were saying, "Oh, this is going to be another, Great Depression." Well, there's nothing. Those two, the coronavirus and the Great Depression are two very different things, and the causes for the two crises are very different. So I think those types of comparisons are not helpful and frankly not going to be very accurate when we look at this going backwards. So.
No, I think people have just a tendency to like want to draw to like the worst case scenario though, and like I guess in history for people in financial situations, like the Great Depression is the worst case possible in their minds, and so they're like, oh well, people are always predicting the end of the world. Well, this is just another way. Like this is just them trying to predict the end of the world again. Like this is the Great Depression. Maybe it will be, maybe it won't be. I mean, I don't think it will be, but I think that's just the tendency. And we see that now, even like drawing back to the financial crisis. You're right. Like totally different scenario, completely. And I think there were lessons actually learned during the financial crisis that are probably making policy a little bit better today. But you're right, it's totally different. The results will be totally different as well. And so just trying to compare it back to those things, it's almost a useless exercise because it's not going to be the same no matter what. It's never the same. The only thing that I'd say is the same or similar is that behavioral patterns in investors are somewhat similar because you see like the panic, you see the fear, you see the greed eventually kick in, and you see those same kind of patterns happening at different times. But like that's probably the only thing I would say is similar and that you can kind of draw on is that human quotient of a component to it.
Yeah, I think like both the 2008 and the Depression they were actually caused by human errors, like people at the Federal Reserve and in central banks and in government made errors, and those mistakes caused those types of depressions. That's not what's happening here. What's happening is there's a virus and it's a real problem in the real world. And so, but the good news is it's a temporary problem because even in like the worst case scenario, this virus is going to go away, and it's going to go away in within like 12 to 18 months, we'll say probably. So it does have an expiry date on this crisis, and what's good about it and what's different about going on now as what was going on in 2008 or during the Depression even is that central banks and governments have stepped up massively, like more than they ever have before. So, that is going to help support the economy and it's going to help support markets. And so I think we're going to come out of this looking pretty good. But we'll have to wait and see.
Yeah, I would agree. I mean, I think that just as maybe a final thought, I think that like high quality businesses are going to do really well out of this because I mean, I think some competition is probably going to be eliminated that's maybe lower quality. And I also think that like highly adaptive businesses are going to do well out of it. I mean, I could be wrong. I mean that, yeah, things might go back to exactly the way they were before as well. And I expect that most of it will, but I'd also think that there's an opportunity being presented right now for good businesses to take advantage of. And I think high quality or good management teams are actually looking at that more than anything else right now is how do we come out of this stronger than ever. So I think it's going to be interesting to see on the other side, but I do think that we're going to be in a better spot for everything that's going on today. And that's, I guess, the silver lining of all this, despite all the bad things going on today, is that I think we come out stronger in the end.
100%.
Yeah. Okay, man. Thanks very much. I appreciate it.
Yeah, thank you.
Take care.
Bye.